Good morning, all of you. Today we will start Unit 2. So, Unit second name is Introduction to Foreign Exchange Market. Today we will start Unit second. So, first we will learn the learning objective of this unit. There are three learning objectives of this unit. So, first learning objective is the introduction to foreign exchange markets. In this point, there are various subpoints. So, first is the introduction to foreign exchange market, then structure of foreign exchange market, type of transaction and settlement date, then exchange rate quotation and abbreviation, then interest rate party, then purchasing power party and Fisher party. This is the first learning objective. Then second learning objective of this unit, so forecasting exchange rate. In this point, we will learn the efficient market approach, fundamental approach, technical approach, then global financial market and interest rate. Then last one, the concept and type of currency, convertibility of currency. The last learning objective of this chapter, so exchange rate. In this point, we will learn the nature of exchange rate, then type of exchange rate, demand and supply of foreign currency. Okay, these are the learning objectives of this unit. So let's move on the first point of this chapter. So first point is what is the meaning by foreign exchange markets? So foreign exchange markets means forex or FX markets. So foreign exchange market institution for the exchange of one country currency with that of another country. Foreign exchange markets are actually made up of the many different markets because the trade between individual currencies, say the euro and US dollar, each constitutes a market. Then the example of foreign exchange market. So foreign exchange forex is the trading of one currency for another. For example, one can swap the US dollar for the euro. The forex market is the largest and most liquid market in the world with the trillions of dollars exchanged hand every day. Okay, this is the definition and example of foreign exchange market. We will move to the next part. So next and important part of this unit, the structure of foreign exchange market, like forex market. The structure of foreign exchange market constitutes central banks, commercial banks, brokers, exporters and importers, immigrants, investors, tourists, etc. These are the main players of foreign exchange markets. Their position and place are shown in the figure below. Okay, this picture shows the structure of foreign exchange market. There are main four roles in this structure. So first is the central bank, second brokers, third commercial banks, and last one fourth is exporter, importer, tourist, investor, and emigrants. I'll explain one by one. So let's start. At the bottom of the pyramid are the actually buyer and seller of foreign currency exporter, importer, tourist, investor, and emigrants. They are actually user of the currency and approach commercial bank to buy it. The commercial banks are second most important organ of foreign exchange market. The banks dealing the foreign exchange play a role of market of marketers in the sense of that the quote in deal base of foreign exchange rate for buying and selling of the foreign currency. Also, they function as clearing house, thereby the helping in weeding out the difference between of demand and supply of the currency. These banks buy the currency from the broker and sell to it the buyers. The third layer of pyramid the constitutes of foreign exchange brokers. These broker functions are link between central bank and commercial bank and also between the actual player and commercial bank. They are the major source of market information. These are the persons who do not themselves buy the foreign currency but rather reach a deal between the buyer and seller on a commission basis. The central bank of any country is the apex body of the organization exchange market. They work as the leader of the last resort and the custodian of foreign exchange of the country. The central bank has the power to regulate and control the foreign exchange market so as the ensure that it works in orderly fashion. One of the major functions of central banks is to prevent the aggressive fluctuation in the foreign exchange market, if necessary by the direct intervention. So intervention in the form of the selling the currency when it is the overvalued and buying it when the trade to the overvalued. Okay, these are the structure of forex market like foreign exchange market. Students, we will move to the next part. So next part is the function of foreign exchange market like forex market. So foreign exchange market is the market where the buyer and seller are involved in buying and selling of foreign currency. Simply, the market in which currency of different countries are bought and sold called a foreign exchange market. See, there are three functions of foreign exchange market. So first function is transfer function, second is credit function, third is hedge function. Okay, so let's move on to first function. The foreign exchange market is commonly known as Forex, and Forex a worldwide network that enables the exchange around the globe. The following are the main functions of foreign exchange market, which are actually the outcome of its working. So first is the transfer functions. In this function, the basic and the most visible function of foreign exchange market is the transfer of funds, foreign currency, from one country to another for the settlement of payment. It's basically the conversion of one currency to another, where in the role of forex is the transfer the purchasing power of one country to another. For example, in the export, the Indian import goods from USA and the payment is made by in dollar. The conversion of rupee to dollar will facilitated by forex. The transfer function is performed through a use of credit instruments such as bank drafts, bill of foreign exchange, and telephone transfer. Okay, this is the real and actual information of the transfer function. So next function is a credit function. In this credit function, so forex provides a short-term credit to the import so as to facilitate the smooth flow of goods and services from one country to another country. An importer can use the credit to finance a foreign purchase, such as the Indian company wants to purchase the machinery from USA, can pay for the purchase by issuing the bill of exchange in foreign exchange market, essentially with the 3 month maturity. Okay, this is the maturity period of credit function. Then the last function is the hedge function. In this point, the third function of foreign exchange market is to hedge foreign exchange risk. The party to the foreign exchange are often afraid of the fluctuation in the exchange rate, that is, the price of one currency to term of another. The change in exchange rate may result is an gain or loss of party concern. Thus, due this reason of foreign exchange provides services and hedge the anticipated or actual claim liabilities in exchange for the forward contracts. So forward contracts is usually the 3 month contracts to buy and sell the foreign exchange from another currency at fixed date in future price agreed upon today. Thus, no money is exchanged at the time of the contract. There are several dealers in foreign exchange market. The most important almost them are the banks. The banks have their branches in different countries through which the foreign exchanges facilitate such a services of bank is called as exchange bank. Okay, so students, these are the three functions of foreign exchange market. Let's move on the next part. So next part is the type of foreign exchange markets. So type of foreign exchange transactions. So foreign exchange transactions refers to the sale and purchase of foreign currencies. Simply, the foreign exchange transaction is an agreement of exchange of currency of one country for another at agreed exchange rate on a definite date. Okay, students, there are five types of foreign exchange transactions. I'll explain one by one. So move on the first transactions. So first transaction is spot transaction. In this type, in this type, the spot transaction is when the buyer and seller different currencies settle their payment within 2 days of the deal. It is the fastest way to exchange the currency. Here, the currency are exchanged over a 2 day period, which means no contracts is signed between the two countries. The exchange rate at which the currency are exchanged is called as spot exchange rate. This rate is often the prevailing the exchange rate. The market is which the spot sale and purchase is currency is facilitate is called as the spot market. Okay, this is the spot transaction. Then the second transaction is the forward transaction. The forward transaction is a future transactions where the buyer and seller enter into an agreement of sale and purchase of currency after 90 days of the deal at fixed exchange rate on definite date of the future. Okay, students, listen carefully. Spot exchange transaction have 2 day deals and forward transactions have 90 days of date. The rate at which the currency is exchanged is called as the forward exchange rate. The market in which the deal for the sale and purchase of currency at some future date is made is called a forward market. The next transaction is the future transactions. Okay, so future transactions under the future transaction are also forward transaction and deal with the contract in same manner in the normal forward transaction. But however, the transaction made in future contracts differ from the transaction made in the forward contract on the following grounds. There are three grounds. So first is the forward contracts can be customized on the client request, while the future contracts and standardized, such as the future date and size of the contract is standardized. Then the second ground is the future contract can only be traded on the organized exchange, while the forward contracts can be traded anywhere depending on the client convenience. So third ground is the no margin required in case for the forward contract, while the margin are required of all participants, and if initial margin is kept allocated like collateral also established in future position. Okay, this is the future transaction. Then next transaction is swap transaction. So swap transaction involve the simultaneous borrowing and lending of two different country between two investors. Here, one investor borrow the country and give another currency to the second investor. The obligation to repay the currency is used a collateral and the amount is repaid at the forward rate. The swap contracts also uh, the swap contract allow the investor to utilize the fund in currency held by him or her to pay off the obligations determined in the different currency without suffering of foreign exchange risk. The last one, the type of foreign exchange transaction is the option transactions. So option transaction under the foreign exchange option gives the investor the right but not the obligation to exchange the currency in one denominations to another at the agreed exchange rate on the predefined date. An option to buy the currency is called as the call option, while the option is sale, the currency is called as put option. Okay, so this is all about of the types of foreign exchange transaction. Then the next is the what does the exchange rate means? Okay, so what is the definition of exchange rate? So exchange rates are ratio that use cross in international markets, including finance, trading, and investment. Businesses and investors are use the rate of compare that the currency purchasing power with another countries. They also use this determine the comparative strength of their domestic currency against the foreign currency. Then additionally, these rates are either the floating or fixed. So floating rate occurs when the market determines the rate. The fixed rate is where a country feels their domestic currency and some widespread currency.